It is concerning how short people's memory can be, leading them to believe that everything is fine simply because a recent event is in the past. However, beneath the surface, there are numerous issues that people fail to grasp. This lack of awareness will only exacerbate the situation because you cannot avoid or prepare for something you are oblivious to. Many individuals are fixated on what occurred in the past month, particularly with regard to the banking sector, but when you step back and examine the larger picture, the macro side of things, you realize that there are more significant concerns. Take, for instance, the banks. Some individuals may think it's alright that JP Morgan smoothed things over, but this overlooks the broader context. If you look at the macro perspective, you'll see that the bank situation is just one piece of the puzzle. There are deeper problems that deserve attention. One major issue that has recently gained attention is the debt ceiling. However, people are fixating solely on the fact that we keep bumping up against this arbitrary limit, while ignoring the larger problem of our $31 trillion national debt. Furthermore, they fail to acknowledge the staggering unfunded liabilities in our country, which are over 4 times the national debt. Medicare and Social Security alone have a combined underfunding of $76 trillion, 2.5 times the size of the national debt. This burden, encompassing government, military pensions, and more, is immense and not disappearing anytime soon. When it comes to paying off a debt of $150 trillion in unfunded liabilities, there are only 2 options, as Richard Russell foresaw 20 years ago: inflate or face dire consequences. Looking even broader, we can consider the insights of Kristalina Georgieva, the head of the International Monetary Fund, who highlighted complacency within the U.S. banking sector as a significant problem. The ease with which people can move their money with a click of a mouse is seen as problematic, necessitating increased supervision and regulatory action. Considering the current key advisors to the president, Jared Bernstein and Lael Brainard, we witness their respective theses. Bernstein advocates for the removal of the dollar as the world reserve currency, while Brainard focuses on eliminating banks altogether. Interestingly, the events unfolding domestically seem to align with their goals. One scenario sees the dollar losing its reserve status, while the other sees the elimination of traditional banks. This situation could easily fit into both of their narratives. As a result, we observe a mass exodus not only from regional banks, but also from commercial banks. Moreover, the Federal Reserve, an institution inadvertently aiding and abetting this departure from banks, offers interest rates higher than those available at any bank, albeit with the systemic risk of being dragged down by the banks. These underlying issues are often overlooked or disregarded by the majority of people. While some may argue that gold and silver have not performed significantly recently, there are numerous factors indicating otherwise. For instance, consider the unprecedented accumulation of gold by central banks in the last 18 months. Additionally, the COMEX now holds a mere 29 million ounces in the registered category, and commercial banks currently hold approximately 9,000 short contracts, equivalent to about 45 million ounces. However, there are only 29 million ounces available for delivery in physical bars. This raises concerns about a potential shortage of 15 million ounces. Where will the shortage be met? Who will sell it? Are we on the verge of a major crisis? Could this be the reason for the increasing withdrawal of metal from exchanges? These are critical questions that deserve attention, even if some choose not to listen. It is crucial for people to recognize that the stability of the banking sector is just one piece of the puzzle. Our national debt, along with the massive unfunded liabilities, presents a significant burden on the economy. Merely bumping up against the debt ceiling without addressing the root causes of our financial challenges is a short-sighted approach. Furthermore, the viewpoints of influential advisors to the president, such as Jared Bernstein and Lael Brainard, suggest potential systemic shifts in the financial landscape. Their proposals to remove the dollar as the world reserve currency and eliminate traditional banks have far-reaching implications. It is essential to understand the potential consequences and closely monitor the developments in these areas. In the realm of precious metals, notable trends are emerging that warrant attention. The accumulation of gold by central banks is at unprecedented levels, indicating a loss of confidence in traditional financial instruments. Moreover, the dwindling availability of physical gold and silver for delivery raises concerns about the stability and potential risks within the commodities market. All these factors and more emphasize the need for a broader perspective and deeper understanding of the complex financial landscape we are navigating. It is crucial to avoid complacency and delve into the underlying issues that impact our economy, financial systems, and long-term stability. They are attempting to skillfully navigate their way out of this situation. Currently, there is a significantly large managed money trader who holds the largest short position among all managed money or short positions. It's unclear if this trader is affiliated with BlackRock, as they recently took a substantial position in PSLD. There are multiple factors that should give people pause and reconsider ignoring the momentary calm before the storm. Complacency will be detrimental, and it is essential to be prepared. As I have consistently stated, whatever unfolds will happen gradually, little by little, and then all at once. This pattern is often observed in economics, as exemplified by the story of Hemingway going broke. Many aspects of this industry follow a similar trajectory. If one hasn't noticed, all the things we have discussed at length have been gradually unfolding. It would be foolish to be blindsided when everything happens suddenly. This is the most frustrating aspect for me. People believe everything is fine just because recent events have blown over. However, if I were to speculate, the old saying, "The calm before the storm," will hold great significance as we approach the debt ceiling. By examining the credit default swaps, which have been increasing rapidly, one can see that the banks are concerned about defaults on various assets, including mortgage-backed securities and deals with other banks. The current level of credit default swap premiums for Treasury defaults hasn't been this high since the 2008 financial crisis. Sophisticated investors are signaling that we are far from being out of the woods. When Janet Yellen mentioned that if the government shuts down and the lights go out, numerous banks, possibly dozens, may fail, it reinforces the notion of this being the calm before the storm in many respects. It is alarming to consider the FDIC as a safety net. It seems feeble, like a piece of dental floss beneath the trapeze. At the end of 2022, the FDIC had to borrow $173 billion from the Federal Reserve, while the entire U.S. banking system had a mere $128 billion in reserves. With the commercial banks removed from the equation, there are $9 trillion in deposits in 4,000 regional banks, backed by only $128 billion. It becomes evident that the obligations and backing for these assets are dependent on the continued erosion of the U.S. dollar through inflation. There is no way out of this predicament. It's a choice between default or inflation. We cannot produce our way out of this situation, as we have offshored much of our manufacturing and production. It's worth noting that the advisors to the president advocate for eliminating the world reserve currency and destabilizing the banks. It may be viewed as a coincidence, but considering all the moves we have made, such as weaponizing the dollar and pushing for green initiatives that challenge the petrodollar status, they are counterproductive for a country that should cherish the privilege of being the world reserve currency. Instead, we resemble a spoiled child who squanders their family fortune, spending recklessly and constantly borrowing more. We find ourselves in a position where we need to borrow money to repay previous debts or pay interest on borrowed funds. It's a precarious situation, and it's disheartening that our president doesn't fully grasp the severity of it as we approach the 11th hour of a potential default.